Hey everyone, it's Paula. Welcome back to the channel where we break down what's really happening in crypto and why it matters. If you've been watching the markets lately, you'll know it's chaos. Bitcoin slipped under 100k, fear through the roof, and altcoins are bleeding. But behind all of that volatility, something much bigger is quietly happening here in the UK. On the 10th of November, the Bank of England and the UK Treasury are dropping the first official rulebook. It's being called the UK Stablecoin consultation, but make no mistake, this isn't just another policy paper. This is the foundation of a brand new digital financial system, and today I'm breaking down exactly what's in it, why it matters, and what it means for people holding Bitcoin, XRP, or even stablecoins for day-to-day trading. For years, the UK talked about being a global crypto hub, but let's be honest, it's been mostly talk. We've had debates, task forces, pilot projects, and still no clear rules. That changes now. On the 10th of November 2025, the Bank of England and the Treasury will release a joint consultation on stablecoin regulations. This is the moment the UK goes from watching the market to controlling it. To give you context, stablecoins have exploded in usage. Back in 2018, global stablecoin circulation was under $3 billion. Today, it's over $150 billion and climbing. They're becoming the backbone of crypto trading, payments, and even DeFi. So for central banks, they're not just an asset class anymore, they're competition. And that's why this consultation matters. It's the first step in defining who gets to issue money in a digital world. The consultation paper landing on November the 10th is the UK's first detailed proposal for regulating stablecoins used for payments. It's being launched under powers from the Financial Services and Markets Act 2023, the same law that formally bought digital assets under UK financial regulation. So here's what we know so far. It sets out rules for issuance, reserves, and redemption, meaning every stablecoin must be fully backed one-to-one by high-quality liquid assets like cash or short-term UK gilts. It introduces holding limits, reportedly around £20,000 per individual and £10 million per business, to reduce systematic risk if users pull funds too quickly. It splits oversights between regulators. The Bank of England takes the big payment level stablecoins, while the FCA covers exchanges and wallets. The Bank of England's Deputy Governor Sarah Breeden said something interesting. Our framework will be implemented as quickly as the United States. Translation, the UK's trying to match, even outpace Washington's timeline. They don't want London left behind the digital currency race. So what happens if these proposals become law? First, stablecoins like USDT and USDC will need local authorization to be used inside the UK payment system. They'll have to prove their reserves are clean, audited, and held in approved assets. Second, crypto companies handling stablecoins, exchanges, custodians, wallet providers will be treated like financial institutions. That means capital requirements, internal audits, and regulatory reporting. Third, transaction limits. Those 20k and 10 million caps sound high, but they create a psychological ceiling. It stops stablecoins being used as large-scale savings accounts or cross-border settlement tools outside the banking sector. And there's even a bigger layer, privacy. Once stablecoins are fully integrated, every issuer and provider will need KYC and AML controls. That means more tracking, less anonymity, and fewer loopholes. Let's talk motives. Why push this through so quickly? Two words: competition and control. Competition, because the US is pushing its own stablecoin act, and the EU's MiCA framework already came into force this year. London doesn't want to fall behind as a fintech centre. Control, because the Bank of England knows that privately issued stablecoins are becoming too powerful. They threaten the central bank's monopoly on money creation. So this is part of a balancing act. Encourage innovation while quietly reasserting control, and it conveniently paves the road for the digital pound, sometimes called Bitcoin. By regulating stablecoins now, the Bank of England creates the infrastructure for its own central bank digital currency later. The pipes will already be built, wallets, identity checks, transaction monitoring, all ready for when a digital pound launches. Here's where it all ties together. The Bank of England has been studying a CBDC since 2021, and the latest reports hint a prototype system could appear by 2026. The same time stablecoin rules go live. Coincidence? Hardly. The digital pound would exist alongside cash, but unlike stablecoins, it would be issued and controlled directly by the Bank of England. Every transaction would be traceable. Once stablecoin users get used to regulated wallets and verified IDs, switching to a government-backed version will be seamless. So think about the 10th of November as the dress rehearsal for the CBDC era. The consultation isn't about safety, it's about setting the framework for programmable, central controlled money. Reactions are split down the middle. Some crypto leaders welcome it. They say we've been asking for clear rules for years. Now we can finally build with confidence. It's true, regulation brings legitimacy and might attract more institutional money to the UK, but others see the danger. One CEO said, "This isn't innovation, it's nationalisation of digital finance." And that's a fair point. Every rule that protects consumers also reduces personal freedom. The real question is, can we have both safety and sovereignty? Because history shows once financial oversight expands, it rarely shrinks. Let's bring it home. If you're trading or investing in the UK, here's what to expect. Some exchanges might need new FCA licenses, possible delistings, or temporary disruptions. Stablecoins like USDT could face restrictions unless issuers comply with UK reserve rules. More KYC and source of funds checks. Potential tax implications if stablecoins are classified as regulated payment instruments. The good news, it could weed out scams and improve security. The bad news, it edges us closer to a monitored financial grid where every transaction passes through government-approved pipes. When Deputy Governor Breeden said the UK would coordinate closely with the US, she meant more than timing. It's about creating a global template where only a handful of approved stablecoins get banking access, Circle, PayPal, and maybe a UK-issued pound-backed coin. Everyone else? Shut out. That means the era of wild experimental stablecoins could end within a year or two. What replaces it is a tightly controlled network of digital currencies, all linked, all compliant, all traceable. Whenever money evolves, regulation follows. When banks introduced paper notes in the 1600s, governments rushed to license them. When online payments exploded, we got AML laws and KYC rules. Crypto's no different. The same cycle repeats. Innovation, adoption, regulation, consolidation. But every time we lose a bit of freedom in exchange for security. The difference now is scale. Digital money moves globally in seconds, so regulation must too. That's why the Bank of England and the Fed are syncing timelines. Once the regulation drops, we'll have a 90-day window for public and industry feedback. After that, the final framework will likely be announced mid-2026, right alongside early CBDC testing. So keep an eye out for three things. Which stablecoins apply for UK approval, whether the 20k limit stays or rises. These three signals will tell us whether this is about fair regulation or a slow transition to total monetary control. Here's the truth. The 10th of November won't crash the market. It won't change prices overnight, but it will mark the beginning of the end for unregulated crypto in the UK. The Bank of England isn't trying to kill crypto, it's trying to own the rails it runs on. Whether you see that as progress or control depends entirely on why you got into this space in the first place. If you came for short-term gains, regulation might feel safe. If you came for freedom and independence, this should be a wake-up call. If you found this breakdown useful, make sure to like the video, subscribe, and drop your thoughts below. Do you think the UK is creating safety or setting the stage for control? And if you want to go deeper, chart analysis, live sessions, and community discussions about how to navigate these shifts, message me the word Wolfpack, and I'll send you the link to our group. We talk markets, regulation, and strategy. No hype, just real insights. Because the next phase of crypto isn't about guessing the next pump. It's about understanding the system that decides who wins and who gets left behind. Thank you for watching, and I'll see you on the next one.